One New Zealand stock was down more than 80% in the year to June, but it just got a glimmer of hope.
Yeah, I mean, it's still a very uncertain situation, and there's a whole range of outcomes that could still happen.
And cyclicals, they're back. House prices are once again helping Fletcher building and retirement village operators. It's Friday, the 7th of July, and you're watching Markets with Madison. We're going to start with the bad news first and reveal the worst performing stocks on the NZX in the year to June. This is on a total shareholder return basis, so it does include dividends. The losers include Spark and Westpac Banking Corp. Freightways and Scalar are down 15% year to date. EBOS Group, the much-loved pharmaceutical distributor, is down about 17% year to date. It suffered a big price drop in June, losing as much as 10% on a day that it announced it lost a key contract with Chemist Warehouse in Australia, worth $1.9 billion. Its stock has recovered a bit in the past week as some saw it as an opportunity to buy, including BlackRock taking a minority stake. Scales Corp is down around 20% year to date. Its apple crops are suffering from Cyclone Gabrielle's impact. And A2 Milk is having a bad year, down almost 30%, with China's recovery not going as well as hoped. The Warehouse Group, our biggest retailer, is feeling the recession. Its profits have plunged and so has its share price. Synlait Milk, a supplier to A2, has seen its value halve this year as it's not delivering for investors, posting an 80% drop in its half-year profit and 30% increase in debt in the half-year period. The worst performing stock, though, by a long shot, was Pacific Edge. It fell almost 80% in the year to June to around 10 cents a share. The company that sells bladder cancer diagnostic tests in the US lost Medicare cover, a decision that would destroy most of its revenue. Well, a Jarden analyst, Christian Bell, was recommending Pacific Edge at the beginning of this year. Hey, Christian. I was going to ask how it felt to have the worst stock pick of the year, but the company's actually this week announced a positive update. Does that change the prospects at all for Pacific Edge?
It is quite a turn of events. It is something that Pacific Edge had highlighted in its annual report that was provided in June, that they were going through an appeals process to try and get this decision delayed for as long as possible, because it gives them a chance to sort of have a sit down conversation with Novitas and sort of address some of the points that Novitas had raised in its initial kind of decision. It is definitely a positive point in the process for Pacific Edge. It still is very uncertain in that they could go through this sort of open public process again, and by the end of it, the medical decision still might remain the same.
Tell me about this Medicare decision. I know you were surprised by it. Clearly investors were, and the company was as well. Just how left field was it?
So yes, it was very left field. So the draft LCD came out June last year. Went for the public consultation process like it always does, and that ran till July. And so Pacific Edge submitted its feedback, and then we never heard back from Novitas for basically another 12 months, which is in itself, it's not normal. And then when they did come back, to most people's surprise, the original draft document came back it went from about 13 pages or so. It was a real change in scope in the process, and I guess that's reflected in the decision today that the governing body that sort of sits above the Medicare program has their lawyers, basically the legal arm of that governing body, has been in contact with Novitas, obviously, and said, no, look, sorry, the procedures haven't been quite right here. Look, I mean, clearly it was a big surprise to the company, to to us, and I guess just the market in general, and that was reflected in how the share price reacted.
We all did know, though, that this Medicare cover process was happening and that there was potential for them to no longer cover it. That risk very clearly existed. And even the chief executive, Peter, came on this show, and when I asked him whether or not this could be make or break for his company, he seemed extremely lax about it. So why did no one, including yourself, really take this risk that seriously?
It's not that we didn't take the risk seriously. I think like we always knew that there was the risk there. I guess while we knew that it was a risk the whole time, the sort of the feedback provided by Novitas in its literature review or technical analysis created significant uncertainty as to the funding and I guess the credibility of the test in the market, which wasn't, I guess, on people's radar before we actually knew what their decision would be. So
you were overweight the stock at the beginning of this year. I'd love you to explain your reason for picking it. What did you think the upside opportunity could or should have been for this year?
So at the start of the year, that in the space of 12 months since new management came in, they had really filled a lot of the capability gaps that were sort of that were there for Pacific Edge. They built out a medical affairs team to sort of generate the on the ground awareness within the urologist community, and you could see evidence of that at symposiums and things like that. More and more key opinion leaders were starting to advocate for the test. So just generally, the awareness and the number of urologists using the test was starting to rise, and so all those things were looking very promising. And the balance sheet, the balance sheet was strong. That was kind of supporting that. We still think it's when it's used in its correct way, which is not how Novitas assessed it. It provides quite a lot of clinical utility to the urologist community. It basically means that a bunch of people that would normally require a cystoscopy, you can funnel out a lot of people and focus on the ones that actually require it, and it meets a real clinical need in the urology space, and they were starting to really make some really good progress. And yes, and I guess the Novitas decision really pulled the rug out. So yeah, I mean, we'll be watching keenly as to what happens over the next 2-3 months. We don't know how long this process is going to be, but we'll be watching very closely, obviously.
My guess is you're no longer recommending the stock, though?
I think it's still very uncertain, because while the process has basically been sent back for open public consultation, Novitas could easily come back and say, no, we stand by our medical kind of our original view. So yeah, I mean, it's still a very uncertain situation, and there's a whole range of outcomes that could still happen. So who knows? We'll have to wait and see, I think.
Well, I appreciate you coming on the show, Christian. Investing is not always about winning, so thanks so much for fronting up for this one.
No problems, Madison. Thank you.
Okay, now it's time for the winners. Here's the top 10 NZX 50 stocks in the year to June, again on a total shareholder return basis. Goodman Property Trust paid dividends in March and June. Tourism Holdings is recovering from COVID. It had a very well-attended investor day a few months ago too. Retirement village operator Arvida lost value on its properties but still paid a dividend in June from retained earnings as its sales increased. Tech company Vista Group is up 18% year to date after announcing it'll lay off staff to hit a free cash flow positive position next year. The clothing retailer Hallenstein Glassons has bounced back, finally being able to report a period without lockdowns impacting its sales. Its chief executive has resigned. He's going in November, and I'm yet to hear of a new appointment. Some defensive names did well. Power company Mercury benefited from one of the wettest periods ever, boosting its hydro generation. Its release about it literally said wet, wet, wet in capitals with an exclamation mark. Infratil bought all of One New Zealand, formerly known as Vodafone. That was a deal that investors very much liked. Fletcher Building and Ryman Healthcare both getting a boost from house prices, seemingly finding a floor and starting to rise again. While Serco, the travel software company, is another post-COVID recovery story. Its share price is up 72% year to date, with almost all of that gain coming in just the past 3 months. The clear thing that I've seen out of this first half is that cyclicals are very clearly back. If you're happy to share, I want to know how your picks have gone this year. Have they been proven right or punished? Let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.